1. Merger. A merger is a combination of two or more companies into one new entity, usually with the aim of creating synergies, increasing market share, or reducing costs. Disney and Pixar merged in 2006 to create some of the most successful animated films of all time, such as Toy Story, Finding Nemo, and Frozen. Exxon and Mobil merged in 1999 to form the largest oil company in the world, ExxonMobil, with a combined market value of over $300 billion. Daimler-Benz and Chrysler merged in 1998 to create Daimler-Chrysler, a global automotive giant that aimed to compete with rivals such as Toyota, Ford, and General Motors. 2. Synergies. Synergies are the benefits that result from combining two or more entities, such as increased revenues, reduced expenses, or improved performance. AT&T and Time Warner, expected to generate synergies of $2.5 billion by 2021 from their merger in 2018, by combining their content, distribution, and technology capabilities. Amazon and Whole Foods achieved synergies of $150 million in 2017 from their acquisition deal, by offering lower prices, faster delivery, and more convenience to their customers. Facebook and Instagram created synergies of $1 billion in 2012 from their acquisition deal, by enhancing their social media platforms, increasing their user base, and expanding their advertising revenue. 3. Economies of scale. Economies of scale are the cost advantages that result from producing larger quantities of a product or service, such as lower unit costs, higher efficiency, or better bargaining power. Walmart benefits from economies of scale by operating more than 11,000 stores in 27 countries, which allows it to lower its costs, negotiate better prices with suppliers, and offer competitive prices to customers. Netflix enjoys economies of scale by having more than 200 million subscribers in 190 countries, which enables it to reduce its per-unit costs, invest more in original content, and increase its market share. Boeing achieves economies of scale by producing more than 800 aircraft per year, which helps it to optimize its production process, improve its efficiency, and gain a competitive edge in the aerospace industry. 4. Market expansion. Market expansion is the strategy of entering new markets or segments with existing or new products or services, usually with the aim of increasing sales, profits, or customer base. Starbucks pursued market expansion by entering China in 1999, where it now has more than 4,700 stores and plans to open 600 more per year, making it the company's fastest growing and most profitable market. Apple followed market expansion by launching the iPhone in 2007, which opened up new segments of customers who wanted a smartphone that combined a phone, a music player, and a web browser. Nike implemented market expansion by introducing the Air Jordan brand in 1984, which targeted basketball fans and enthusiasts who wanted to emulate the style and performance of Michael Jordan. 5. Integration. Integration is the process of combining two or more entities into a unified whole, such as merging operations, systems, cultures, or teams. Google integrated its various products and services, such as Gmail, Google Drive, Google Photos, Google Maps, and Google Assistant, to provide a seamless and personalized user experience. FedEx integrated its different business units, such as FedEx Express, FedEx Ground, FedEx Freight, and FedEx Office, to offer a comprehensive and reliable delivery service to its customers. Marriott integrated its multiple hotel brands, such as Marriott, Ritz-Carlton, Sheraton, and Westin, to create a diversified and loyal customer base, as well as a unified loyalty program, Marriott Bonvoy. 6. Organizational structure. Organizational structure is the way a company or entity is arranged or divided into different units, levels, roles, or functions, such as hierarchical, flat, matrix, or network. The organizational structure of a company can affect its efficiency, productivity, and innovation. Some companies have a flat organizational structure, which means they have few or no levels of management between employees and executives. A matrix organizational structure is a hybrid of functional and project-based structures, where employees report to both a functional manager and a project manager. 7. Valuation. Valuation is the process or method of estimating the worth or value of a company, asset, or product, based on various factors, such as financial performance, growth potential, market conditions, are comparable transactions. The valuation of a company can help investors decide whether to buy or sell its shares. One of the most common methods of valuation is the discounted cash flow (DCF) method, which calculates the present value of the future cash flows of a company. The valuation of a product can depend on its features, benefits, quality, and customer satisfaction. 8. Deal structure. Deal structure is the arrangement or design of a transaction or agreement, such as the type, amount, and timing of payments, the allocation of risks and responsibilities, or the contingencies and clauses. The deal structure of a merger or acquisition can involve cash, stock, debt, or a combination of these. A deal structure can also include earn-outs, which are payments that depend on the performance of the acquired company or asset after the transaction. The deal structure of an investment can determine the ownership, control, and rights of the investors and the entrepreneurs. 9. Regulatory approvals. Regulatory approvals are the permissions or authorizations required from the relevant authorities or agencies to conduct a certain activity or transaction, such as mergers, acquisitions, or investments. Regulatory approvals are often required for businesses that operate in highly regulated industries, such as healthcare, banking, or energy. Regulatory approvals can take a long time and cost a lot of money, depending on the complexity and scope of the activity or transaction. Regulatory approvals can also provide assurance and credibility to the customers, partners, and stakeholders of a business. 10. Reputation. Reputation is the perception or opinion that others have about a product, service, or company, based on its past performance, quality, reliability, or credibility. The reputation of a company can influence its sales, profits, and market share. A good reputation can be built by delivering high-quality products or services, providing excellent customer service, and acting ethically and responsibly. A bad reputation can be caused by poor performance, customer complaints, scandals, or negative publicity.